A very good morning to you, traders. It's the day after the night before, and all fun and games with Powell. Lots to talk about. Morning, boys.
Hello. Turnaround Tuesday yesterday, right?
It's turnaround Thursday.
Yeah. How are you?
Yeah, all good, mate. You?
Very good. I hope people listened to what we were saying yesterday, both on the Flow Show and on Face, and we're well prepared for Powell.
Yep.
So anyway, we'll talk about that. But the main thing is to be careful and to limit your potential damage. That's always my first priority, and hopefully people did well.
Yeah, exactly. Hopefully, no horror stories. How you doing, Kay? Any snow where you are?
No, it's cold, but I haven't seen any snow yet.
No, it's raining here.
Unless it is snowing and I haven't even looked outside. That's possible.
Yeah, you open a window and you'll be 6 foot under. Right, let's get into it. Obviously, lots to talk about with Powell today and the market moves and what's happened. So we'll get cracking onto the headlines and stuff. Talk of Japan's wage hikes, and apparently big companies are expected to deliver the biggest pay rise in 26 years in the Shunto wage talks. That's the.
So was that 1%?
Yeah, hang on, I'll tell you in a minute. That's in the Shunto wage talks, which is the spring wage offensive, as they call it in Japan. But the expected average salary hike is said to be around 3%.
Oh, wow.
And that will likely just include a 1% increase in base pay. So the rest coming by other ways, bonuses, that sort of thing. So just a 1% increase in base pay. Now, these major talks are due to be completed next week on the 15th. So that's a date for the diary to be circled as to when we get potentially the final numbers coming from these wage talks. According to a Reuters poll, big firms are going to offer average pay rises of 2.85%, so that playing into that 3% number. Japanese Chief Cabinet Secretary Matsuno says they are planning to meet with businesses and union leaders about wage hike on March the 15th. So, as I said, that's the day for it. Not a big hike in general terms, is it, Kay?
No, I was actually relatively surprised. If you see that companies like Toyota and we had what was the other company were going to hike 10 and more percent, the average is underwhelming, to say the least. And that's, I mean, if you take into account, assuming that the setback in inflation is going to stall somewhere, we've seen this setback, but real wages are not going to be ramping up either, and I don't know if that's going to be enough to get the Japanese spender take out money and go and spend on stuff, which is already a big ask in normal times. But that number, if it's the overall number below 3%, that's not going to cut it, I reckon.
Yeah, and at current inflation rates, that's still a real income drop, let alone an increase. But it just goes to show it. If 3% is the biggest hike in 26 years, it just shows you the mess they're in Japan. People will.
Sorry, go on. I was just going to comment something. Go on. I'm just going to comment something.
Afterwards. I was just going to say, people would kick you out the door over here in this country if you offer them a 3% wage hike.
And
true. The next step will be going on strike for that sort of level. But biggest in 26 years if it happens.
It's very interesting because we all talk about Japan and how, the last 25 years or so, or 30 have been basically, lost decades. That's how everybody calls them, right? After the boom, the 1980s, 90s boom. And I was thinking, if inflation has been that low, which it has over these years, and wage growth has also been that low, I was thinking, what's happened with asset prices there? And I just pulled up a chart of residential property prices from the St. Louis Fed site, and we are in Japan. That is, we are at the same levels as we were in the mid '80s, which is astonishing. So basically, the price of a house, the average house in Japan 30 years ago, is the same as now. So that all kind of goes together, right? And if anything, you would prefer to have such a stability in prices, in house prices, in income, in everything. And people slag Japan for having debt to GDP, which is ridiculous, and buying their own debt. But look, they've created something which is very stable. Right. So, if you look at the end result, it's actually not bad. And, you compare that to, the US or, Canada or, UK, and look at house prices in the 1980s. And now, best example I can remember is when my brother and I went to study at Imperial in London. My father bought us a flat on Queensgate, which is, really nice area, South Kensington, very close to the university. And I remember it cost £109,000. And last time I checked, because you can check how, where house prices get sold on the web, I think it was something like $1.5 million now.
Yeah.
which is ridiculous. This was in the 90s, right? Early 1990. And now it's just ridiculous. But look at Japan, very stable prices and, not a bad place to live, I think, in that respect. But anyway, just a note. I was expecting to see house prices a lot higher than the 80s, but apparently they're not.
Yeah, it's an interesting point, I suppose that's what everyone does. They compare Japan to the rest of the world and say, why isn't Japan like the rest of the world? Well, they have got their own thing, if you like. So you probably could have a case to say, well, why do they need to change? It ticks along, it does its thing. I guess the difference is how do you compete on the international stage if you're not in line with some of those, parameters for prices and stuff. But Japan is Japan, and we love them all for it. What do you make of that, Kay? What Stell's just been saying?
Well, two things that coming to mind. That the one is the stability that Stelios is talking about. The other one is it shows you that people don't have more money to pay up, and we have to note that those prices are high. I remember when I was in Japan and I was talking to.
Were you big in Japan?
I've always been big, but in Japan I was a little bit small. I was a little bit lighter. That it's easier to go on a diet and exercise and stuff in Japan than here in Europe. I found out that's a bit of a bizarre statement, but to me that was the case. No, so the guy, one of the guys in the office where I worked. Was buying a very small, because in Tokyo none of there's hardly any building land left, but he managed to grab a very small one, and it's like just a little bit over 100 or 150 square. Is it 150 or 150 square meters or 200 square meters? It's really small over there, right? To build his house on, because they build up, not wide. They build up. Yeah, they're building floors over there. But it still cost $1 million. I mean, so you talk about prices, but about stability of prices. But then if you look at the nominal price, it's pretty steep. I'm talking about Tokyo, of course. In the countryside, it's a lot less.
So basically, they were very expensive in the 80s, and now the whole world is catching up.
Yeah, I think it's a bit of that. And then if you look at asset prices, and you say the last decades is exactly that. The asset prices came down, right? After that, after the big boom, constantly, and people were scared of spending much. So the savings rate in Japan has always been very, very high, right? Yeah, so I've got a bit of trouble to right now look at those prices as a reason for the yen to be stable. Some other stuff has happened in the meantime. But yeah, I mean, it has been a factor for the yen to that stability has actually been part of why the yen is a risk currency for the outside world, right?
Yeah.
Stability in prices, the savings rates, usually the far from my bed show with huge geopolitical unrest and the fact that they have always been a very big exporting economy. But those things, in my opinion, have been changing since, first of all, the big quake, and then have accelerated over the pandemic.
Yeah, exactly. Good insight, lads. Love it. We shall crack on. But just on the BOJ, a Reuters poll of economists say that the BOJ will end YCC in 2023, but a tweak is unlikely this week. Obviously, Friday, another risk event for the yen with Kuroda's last BOJ meeting. Over to Australia, RBA's low says that they are closer to pausing on rate hikes. The timing of a pause will be determined by the data and our assessment of the outlook. Further tightening is likely to be required to bring inflation back to target. Recent rate increases have moved monetary policy into restrictive territory. If the data before the next board meeting suggests a pause, we will do that. So a bit of fence sitting there. They could pause, they could not, they could keep hiking, data dependent, as is everybody else. Coming over to Europe, and retail sales in Germany were a bit soft, down 0.3% versus 2.3% expected. So coming in much lower than what was expected there. Bucking a bit of a trend that we've seen around the rest of the major economies in January retail sales, posting good positive numbers. These numbers are some of these numbers are adjusted for inflation, hence why maybe we're looking at some negatives. Industrial production, on the other hand, came in a solid 3.5% for January versus 1.4% prior. So a bit of a pickup on that side. For the ECB's not says can expect the ECB to keep raising rates for quite some time after March. He's one of the hawks in the camp. ECB's Visco March meeting likely to bring the planned 50 pip hike. However, he had a bit of a moan up at his colleagues, saying, I do not appreciate ECB colleagues' statements on future and prolonged increases in interest rates. The ECB Council has agreed to decide on rates meeting by meeting without forward guidance. So a little further bit of division perhaps coming into deliberations for the next ECB meeting. He's not the only one to have voiced his discontent about forward guidance, and what Lagarde did was pretty much pre-commit to rate hikes, not something that's usual at the ECB. So maybe this ECB meeting might be, as I say, a bit more divisive than usual. But there was an insider story from EconoStream this morning saying that the ECB slowing to 25 pips hikes, but hiking for longer could be a compromise. That'll be a compromise for the doves, of which aren't wanting the ECB to run much faster than they are now. So lots in the mix for the next ECB meeting. Our mate, the basketball player Thomas Jordan at the SNB, says appreciation of the Swiss franc has protected Switzerland from important inflation. They're ready to sell foreign currencies and cannot rule out having to tighten monetary policy again. The first monetary policy meeting of the year for the SNB is on the 23rd, just after the Fed, and the market is pricing a 50 pip hike at 54% and a 75 pip hike at 46%. So a little bit in the middle there of what the SNB are likely to do. For the Bank of England and rate pricing, well, some traders today have fully priced a 5% BOE peak rate for the first time since October. I'm still banging a drum that the BOE will be forced to go to 5%, despite what the clowns are currently saying at the bank. We shall see. The market is coming around to that idea as well. So let's get stuck into the big man, Fed's Powell, and his appearance yesterday. So on balance, he was hawkish, but hawkish to the point of where the market was expecting him to be hawkish. That gave the market a little bit of a confirmation move because we were already looking on the hawkish side. Sorry, Stel.
I was going to say, do you think so? The market was expecting it. I think it was probably, and we talked about this being the risk, right, of him being hawkish. I think he was maybe a touch more than the market expected mainly by saying that they are ready to increase the pace of rate hikes if economic data warrants it. But yeah, I mean, I think you're right, but I just think he was maybe a little bit touch more hawkish than the market expected, hence the reaction.
Yeah, I mean, it's, you know, we can chew it around. I mean, the market had already been expecting him to come, or that's what the market wanted. The market wanted him to be more hawkish. You know, that's why yields were already up. That's why the dollar was back up already. So it got a confirmation of what it's been saying. Market had already been looking at a 50 pip hike. You know, people up Mesta had been hinting at a 50 pip hike. Kashkari, Bullard hinting at the ceiling going higher. So the market was already in that mode, if you like, and this pretty much confirmed it. Yeah, it was probably that was the surprise. And I'll read the headlines out. Is the key headline at the start was that if the totality of incoming data indicates faster tightening is warranted, we are prepared to increase the pace of hikes. Then he added, the ultimate level of interest rates is likely to be higher than previously anticipated, hence so the ceiling perhaps going higher. He said, nothing about the data suggests we have tightened too much. It rather suggests we have more work to do. And the data so far suggests we have a higher terminal rate in our next steps. Talking again about the dots. Ongoing increases in the policy rate likely appropriate in order for stance to be sufficiently restrictive to get inflation back to 2% target over time. Then he had some other generalized answers to questions. Elizabeth Warren grilled him on, she was basically asking him, why are you targeting putting people out of work to get inflation down? Which was a fair question in my mind, and something I've said from the start. It seems bonkers that the Fed actively want to put people out of work just to get inflation down. And she asked that very question. And he replied by saying, we are not trying to raise the unemployment rate. We are trying to create disinflation. And they're trying to realign supply and demand through a bunch of channels, including job openings. Further to inflation and the services side of things, he said, housing services inflation coming down is in the pipeline for the next 12 months. That's been one of the sticky areas. Core services ex-housing is where the challenge is now, and we've not seen the full effects of rate hikes yet. So yeah, I get the market is, and I get your point that he was more hawkish maybe than expected. And I think, yes, that we are prepared to increase the pace of rate hikes is the kicker there. I think the rest is pretty much in line with what the market was waiting for. And I think that part of the reaction was that on hikes, but also sometimes the market needs that confirmation before it moves again. It was already hawkish. It got the confirmation. There was no reason to go the other way, and off it goes again. But also I think a little bit of context is needed in what has happened in the price moves. You know, we put a lot of focus on 10-year yields, and look at that. It just about stuck its nose above the 4% level over Powell. Couldn't even get to the level we saw prior to Powell when we got well into the 4% mark. But then here's where the action was. You look at the 2-year yield, big jump up to 5% and through 5%. The 1-year yield, absolute rocket. This is indicating that potentially we're going to get 50 pip hikes or continued hikes at pace, but it also shows the difference between, say, the 1 year and the 10-year and the 2 years and the 10 years, which is actually a whole 100 basis points difference at one point. That shows that this move that we're seeing in the dollar and seeing in yields is more on the front end. It's more indicating that, yes, the market sees the ceiling perhaps going higher. It sees potentially higher rate hikes, but in the longer term, it just means that those rates are likely to come down a bit faster when the Fed want to move back to neutral. So it's a bit of a spike. So the yield curve has gone a bit steeper, but because 10 years and the rest haven't really changed, it shows you that this is all pretty much short-term thinking, where rates are going over the next few months, not so much where the market sees them or sees them going higher further out. Clay, what are your thoughts on Powell?
Yeah, I think he was more hawkish than the market expected, for sure. Even what I was expecting too, the fact that there was so much hammering on the employment rates, the rates needing to go further than expected, staying higher for longer, and less emphasis than actually over the last FOMC meeting on sheer data dependence. Yes, there was something in the statement, the inaugural statement about it, but I think the market's got taken a bit by surprise, and we are seeing that in the price action, of course. But yeah, he was a bit more hawkish than what I thought as well. But then, as I said, he's clearly keeping the door open now for a 50 BP hike, and that's what the market has to price in, and that's where you see the short term skyrocketing. The longer term is still thinking that, for one, as Stelios was saying, inflation at some stage will come down just by math. So that's the longer end of the curve. But we are now well above 100% inversion between the 2 and 10, which is and the 2 and the longer term. If you look at the 30s, it's even worse. But I think we need to compare the 5 and the 30s. But yeah, I mean, until Friday, or let's say until today and perhaps tomorrow, these comments will resonate, and I doubt that we can have a reversal. But then, and I was saying that in the room as well, and I was early to take profits, and people know I was short Aussie dollar, I was long dollar rand, and I was early to take profits, especially in the rand, because there was another nearly 1%. I think that we've gone up in the meantime, but that's emerging markets for you. But the Aussie is finding a little bit of a footing around 66 or just below. But yeah, I think the market's got a little bit surprised there, and those people who were looking at him hinting at full data dependence, so leaving the door open he for what's to come, perhaps a lower inflation print. When is it? Next week, or a bit of a setback on the labor report. Nothing of the likes. So to me now, where we are, I'm okay to have taken profit on dollar longs, because I personally, this is just my personal opinion, I find the labor market is going to be now the biggest domino that is standing, and I think it has the potential on Friday to just undo everything that we will have heard yesterday and later today, because he speaks again. But it can go both ways, of course, because if we get another strong report, then the market will need to reprice more. And then I think in turn, if we get a strong labor report, not so much the CPI, but it's really just personal opinion, but if we get a strong labor report on Friday, then you're going to see the longer end of the curve catching up on the short end, and the dollar is really going to fly. That is my personal view. If in turn we get a weaker report, which is very possible after the bumper report in January, February, then I think there's going to be the dollar will see a bit of a setback. It all depends, of course, how big the miss will be, and we will talk about that on Friday. But in the meantime, I'm going to err on the cautious more cautious side of things, because it's and you were talking about the short-term impact, which sees the short end of the curve move. That is typical of what we have seen since the pandemic, right? Huge amounts of liquidity in the market, huge amounts to shift around. People have said that they're happy with a plus 5% in the 1 year, park some risk-free money there. Now they can even do it in the 2 years because we're above 5%. So I'm not excluding to see some people dive in there, because even for money managers who are slower reactors and look at the more long term, it's very tempting for them to go and park some money in the shorter end now. But yeah, I think a lot will it's still happening on Friday, and the market being shorter term than it was pre-pandemic, it has the potential to undo a lot, or to see another spike in the dollar. So I'm going to err on the cautious side here for the next couple of days in dollars.
And, we can see what's happened with the rate expectations. I mean, on Monday when I showed the rate expectations, we were pricing a 25 pip hike at the next FOMC at 78%, with a 50 pip hike at 22%. Right after Powell, that flipped to a 25 at 54% versus 46% for a 50. So, close to a coin flip. This morning, we're now pricing a 50 at 62% and a 25 at 38%. So it's completely switched around. Obviously, some of the banks are obviously hiking up their expectations. Goldies has hiked their terminal rate by 25 pips to 5.5, 5.75 now. So it has been a big change around in expectations. But
guys, carry on. I just have a comment afterwards. Carry on.
Yeah. But, we have got risk from this data on Friday for the NFP, because if it comes out really bad, then we're going to undo a lot of this move that we've seen in yields in the dollar. However, just to counteract the counteraction, if we get a poor number in the NFP, it's likely that the market is going to scream skew because of that big outlier number in January, and maybe sort of average it out or something like that. I would expect if we get a number, a minus 100, 200K, anything soft like that, the market will be quick to buy that dip, because this won't change what Powell said yesterday. One bad jobs data, as I say, coming after a big outlier number, is not going to change anything regarding what Powell said yesterday. The market may react that way, but I think there's plenty on the sidelines who have missed this move, who or indeed will just be ready to hit that dip. So be very careful on a bad NFP number. Should we get one on Friday? That's just one scenario, because I don't think any negative move will last from that, and it could be a big opportunity if indeed you've missed these moves at all. Go on, Stel.
No, just one comment I want to make regarding, we're talking about the curve, 2s, 10s, 5s, 10s, 5s, 30s. From my experience, when I used to market make interest rate swaps, I did up to 3 years. So that was all driven mainly by central bank expectations. I used to sit right next to the guys who did the long end. So anything up to 5, 10, 30, 50 years, both bonds and swaps. And what I saw, because I used to cover for them sometimes as well, is that when you go out to 5 years or 10 years and above, it's 90% flow, 10% rate expectation. So if the curve is inverted, 2 stands by 120 or 100 or 80 basis points, the difference is going to be due to flows. Now, obviously, the curve is going to be inverted if we're expecting from these rate hikes, then we're expecting a downturn in the economy and rate cuts, of course. But the magnitude is going to be purely on flow. And if you go out to 30 years, it's 100% flow. So if you're trading 10 years, you have to be aware that you are trading flow. You're not trading fundamentals or this and that. So, if you're trading the 10-year, you can have a move, 30, 40, 50 basis points, which has nothing to do with rate expectations. Just something to be aware of. If you want to take a view on the market and what the Fed's going to do, you have to go a lot shorter in terms of duration.
Yeah,
just a point from my own experience, because I was asked to cover for the long end guys on a few occasions, and it was a completely different proposition to what I used to do for my book.
Yeah, good insight, mate. Thank you very much. Great stuff. So right, coming into some of the prices, and a couple of long-term positions of mine have been knocked out now. Dollar yen was one that I've been shorting way back around 131s, 132s when we were first messing around there. I will continue to short that up to 135s, 130, the high 134s, a little bit more at the 137s. I am now out of that, all at 137.25. I put a stop in. That was my final line in the sand for that trade. So took a bit of a loss on that one. Not as much a loss as I'd set out at the start, because I was taking, as you well know, every time I got in a position and we got a decent move lower, I was taking some profit. So that got the risk down quite well. But it's a loss. Not all the trades we do can work out. And this was a longer term one that hasn't played ball. The data's turned. The Bank of Japan hasn't fulfilled its side. The Fed, obviously, now more hawkish. So everything was lining up against this trade. I haven't liked it for the last few weeks, as I've said on here and in our chat room. Finally put out my misery. Sometimes you need to just have your stop hit, just to sound the death sentence, if you like, put you out your misery, and you can move on to other things. For now, I'm more just playing it short term. I still think there's going to be some moves to come from the Bank of Japan. But the next big story, talking months down the line, is going to be when we get rates to their ceilings, and then start to look at when and how we move down to neutral rates, which is where all central banks want rates to go at the end of the day. So that'll be the next big fundamental player to look at. But for now, out of that trade. Aussie dollar, finally out of my long-term longs that I was taking back from October. Again, those you were in the chat room or on the flow show, I was buying all the way from 64s, 65s down to 62s, and managed to ride it all the way up there. The fibs were my guide as to what was happening with that trend, and they broke and they broke and they broke. So my trailer's been hit just under 66, and I'm out of those longs as well. Also back on the short-term side, get the sniper rifle out. I'm not looking for any big trends for now in this one. Going to see how the rest of the Fed stuff pans out and what happens with Australia and the RBA. So, but technically, I'll be looking at this zone potentially for a long, just to say, playing the text. Down here, we got the 61.8 fib, 65.47, and then it's a bit of a zone down to the 65.20s. Decent resistance zone before we had the break up. So I'm looking for that to show up as support if we come down here. I'll be looking for a long off there and see where it goes after that. For the upside, 66, we're holding below at the moment, give or take a few shekels. That's your level, but then we're going to be getting back up to this broken zone here, which looked to resist pretty much initially straight after we got the breakdown here. Then it's held and we've come all the way down. So this area and back up to 67 is going to be the initial target if we want to see a bounce and see this recover somewhat. If we get up to here, hold below, it keeps the downside in play. We're going to continue this stepping down action that we've seen all the way through this drop from the 71s. It's broken levels, it's held, it's broken again, it's held, it's broken again, it's held. So no need to change a winning team. I know Kay's ridden this down well from higher up and been in and out of shorts into this one. So the trend is your friend, but at some point it will come a time where it will find some support and bounce. It may be we find it here. How we know that is if we're going to move back down to this level, call it 65, 50, 60, and it holds again, then you have maybe some semblance of a bottom. Maybe it just does what it did around the last couple of weeks, which was just fine support, but the bounces were pretty weak. So watch for the price action in that one, but I'm out my longs on that one. I've just got my euro sterling longs and Hong Kong dollar shorts on the books at the moment. So looking at euro dollar, it's getting close to an area I'd like to buy that. That's down at the 105. Been looking at this for a long while. I think given where we've come from, up at 107, and I'm ruining not getting some on there, looking at that level, but we could get down to this 105 here. I think that'll be a fairly decent stretch point, because we have to remember that the ECB is still hiking at 50s and may continue to do so if the various speakers are to be believed. So there's no real reason for this to fall significantly, I don't think. And that 105 level is one that I would be looking to test that theory at. But we're not there yet. We're holding up around the 25s, 30s. So that could be where the market wants to bottom for now. Again, got to look at what it needs to do to get back up. Really needs to get back above the 106 in the first instance. And then perhaps it's going to have another look at 107. But for me, I'm going to be watching this 105, 107 range, see if we can play around the edges there. Obviously, depending on where we are into the NFP, I'll decide what I want to do with that. You know, if it is a big, strong number and we're trading at 105.40, that 105 isn't likely to stand up to much. And we may get a move down, maybe to the next area, 104.60s. But then that will intrigue me even more to eye long, because as I say, the ECB are still going full tilt, even if the Fed have to step up again. Dollar CAD, I mentioned this one, how long I've been waiting for a move to 137, but didn't fancy touching it this close to Powell. And look what it did. You know, you wait weeks and weeks to have a trade, get to the point, you assess the situation, don't want to touch it, didn't touch it, flying through. May have a look if we get up to the 138s, but it doesn't look like it wants to put in too much effort to get out there. Obviously, the Bank of Canada today, so another risk event to look at, see what they come out with. Not expected to do anything. The market may be looking to see if there's a bit more of a dovish slant. I don't think we're going to get much from them. It's going to be, we're on pause, we're watching and waiting. No reason to move either way or even insist on moving either way. So by and large, I would expect the BSC to pass by uninterrupted, if you like. Dollar China was keeping an eye on this up towards the 7 level, and we've had a move up there pretty close, which has held. I haven't done anything. In normal times, I would leave some orders in up close to this. I wasn't going to leave anything overnight, given the volatility that we've got at the moment. So might have missed that first move up towards the 7 number. It's come off quite a bit for now. I'm just going to watch and wait and maybe see if we get another move up there. It's not something at the moment I want to sit with orders in when I'm not at my desk. I'd rather watch it live so I can gauge the price action. But for now, that 7 has proved to be a bit of a stalling point. We'll see from there. I'm sure Kay will talk about it, but dollar MEX looks a bit interesting. We're back above, had a big rally obviously yesterday over Powell. We're back above the 18. If it holds here, do you think you're going to see more upside from here, Kay, if we hold? Would that indicate a bit of a bottom?
I mean, no, the move was yesterday. If it couldn't hold, I'm completely the opposite opinion. No, I mean, that move is very, very weak, in my opinion. If you look at I'll show a bit later, or I'll show it later on. It's no, I think MEX is really the strongest currency out there right now. Can turn on a dime. We know all of that. That's the market, but that move is extremely weak for me. No, but it's probably going to work better or more on the MEX crosses, because you have these dollar move, but and the yields move. And I know a lot of people are watching at the dollar MEX because it's like the instrument to do everything. It's like when you do yen crosses. Everybody looks at the dollar yen, but sometimes the yen crosses are much more interesting than the dollar yen. And mix, I think, is one of those. And I'll have a look at Euro mix as well.
And the one thing I wanted to add, dollar mix, you can probably guess that most people are looking for a rally to 1820, 1830 to sell into, which is probably why it's not going to get there. I mean, I would love to see a rally to 1830, but I doubt it's going to get there.
Yeah, ideally 1850 really on a rebound of the dollar. But then look what, just compare what euro dollar did from 110 down to, so we lost 5 big figures basically, because we rallied up to 110 and a quarter on that famous Chinese opening or whatever. We had this blip up to 110 and a quarter or so. We're 500 points lower, and look where dollar mix is. So look where by deduction, look where mixed crosses are. So I mean, it's just says enough to me.
Yeah. Andy's asking about euro pound. It's failing at the moment to looks like it's failing to hold the 89 handle after another move above. Again, this has pretty much been driven more on what's going on in the pound, the bigger move in the pound in cable than in euro dollar. So it's a bit more volatile, but there is also a bit of divergence in there. If the Fed are stepping up a gear, then the BOE expected to slow. So, you know, that creates further divergence as well. How far it comes down, I don't know. We've been up here before. We couldn't get through this 2030 area. So that's the key one at the moment. Couldn't get through it in Feb. If we get above there, maybe we get a push up towards the highs, the recent highs, and up towards that 90 area. But if we do fail here at 89, likely we're going to go back in the box. That box has been sort of 88, 89, and then we've had the extensions down to the mid 87s, high 87s, mid 87s. So if it does fail here, then perhaps we're going to still be playing this range once more. I haven't let any more off of my trade up here. I did when we got to 89s, close to 89s, but I really want to look for a break up maybe to this 89.50, take some more of my long off that I did back at 88s. But for now, yeah, if we do fail here at 89, it's going to go back in the box, I feel. In that case, you should get your profit. Ali, you're looking for, what are you looking for? I've lost it again. Where's it going? You're looking for 89, 88, 85. Well, at this rate, you look like you might get it in your stops very safe. Gold, you want to have a look at as well. We'll have a quick look at gold. I do know it's holding down near that 1800 level again. Not quite getting down to that low that we saw towards the end of February. So that looks quite significant because the buyers from here look to be protecting it around there. Let's bring it in a little bit closer. So everyone who's buying it down here is parking the bus round about here. So if you're looking for longs down here, you know where you're wrong. I suggest that there's going to be a few stops under this 1800 handle. So if you're looking for longs there, then that's where you want to do it. You're looking on the short side. You're going to have to pick your levels, I think. You know, maybe got a bit of a level here around 1820. You know, a bit of a minor level. The main levels you start getting up to this 1860 and 1870 is where, if you want to short, that would be your ideal level. But then you've got to ask the question, if we're up there, why are we up there? I personally wouldn't short it at this level, but that's me personally. You've got your own trading plans and ideas to get through. Kay, do you want to have a little look around?
What's left to look at?
Yeah, okay. There's always something. You still pull up 30 pairs and have a look at them. You know it.
Yeah, I need to double up on what you have been showing then. All right, let me first go into, let's do another one because I know that Stel is looking at that actively. Silver, Stel, what do we do with it, mate? I've got this little bid in here around, I've got it in at 1980, not even sure we're going to see it, but it's my longer term plan, which has kicked in just around this zone here. I was a little early in stepping in, but that it's
Well, I
not
was earlier than you, right? I
very,
have
very, very small. But
yeah.
yeah, I'm planning to add just a tad more around here. Of course, we need to be very careful with what happens on Friday, because if we get another bumper report, probably yields will fly, and those will really get a kick in the bum, and why not go see an 18 as a big figure, right?
Yeah. Well, my view on sorry to interrupt. My view on silver and gold and metals generally is that I don't think we're done yet. And yesterday's price action was really indicative of what's going on. And we saw, yields barely, obviously 1 and 2 year yields did move, but 10-year barely changed. Dollar, yes, did rally. But gold and silver down 4%, platinum down 5%. It looked like an oversized move, and it kind of almost feels like the beginning of maybe some kind of capitulation move. But I don't think we're done yet. And I was earlier than you in starting to get long. I have a thankfully not big position. It's quite small at an average of 21 and change. So I'm down on that, but I plan to add a lot more. My levels are 1880 to 1910. That's the range where I'm going to go full size. So I don't think we're done yet. We might not get there, obviously, but
this one.
Yes.
This zone here.
Yes.
Yeah.
Yes,
I even
yes.
circled it in the past. That's an interesting zone. Yeah, right. Okay.
And so that's my medium-term view. Can we get there? I think we can, especially if we get good NFP numbers on Friday. There's definitely going to be another move. And we know how silver especially tends to underperform massively when yields rise. And I've said it so many times. It's perverse. It doesn't make sense to be selling something when everything's getting more expensive. Right, inflation is making everything more expensive, and you're selling something because of yields higher and because of gold and silver don't have any yield and don't give you anything. Yeah, but there are things that are needed in the industry, especially silver. So they're going to get more expensive. It's just that this short-term reaction is always, in my opinion, wrong. So I always try to take advantage of that, but slowly, because this can absolutely kill you if you're leveraged.
Yeah, the thing is, we need to be very careful with leverage in stuff like silver. The other reason why it's going faster than gold, I think, is just by the sheer volume of the market. The gold market is much more deeper than the silver market in nominal terms. That's one. And then secondly, I think the manufacturing sector is still underperforming. The services sector may be another reason why silver is weaker than gold. But on the other hand, my reasoning is that whatever happens on rates or whatever happens on inflation, to be honest, is that if the economic data are good, that means that at some stage, this one should find the bottom and go back up, because it's a manufacturing or it's an industrial metal. So that's why personally I'm more than happy, and I'm like you still. I mean, it's like really tiny slices that I'm building up, but I'm building it up for the long term. And even if this thing goes down to 17, I'll still probably be building up, because that's my really long-term plan for this one. But we have to keep stuff really, really, really small and wait for things to turn around on this one. And if we don't get it all, what we want to have done here, or myself personally, if I don't get it all, if it starts to break above 22.10 something, I'm going to be more than happy to press the buttons and buy more, and then buy more if it goes above 24.5, 24.60. I mean, it's just that's a long-term plan. That's how a long-term plan works. You go in really tinies, don't put your account in danger in any way, but be ready for major swing arounds if you're in for the long term.
And you don't need leverage. That's the beauty. You don't need with silver because of the move, the magnitude of the moves. You're not going after 50, 20, 30, 50, 100 pips. You're going after, big
15,
percentage.
20, 30%.
Exactly.
Yeah.
So, I'm not saying people should trade like this. I mean, me and UK, we trade the same way in this with no leverage, but I'm not saying people should do that. But, if you can do that on an unleveraged basis, I think it's a very, very good probability trade, basically.
Yeah, it's one of those things where we trade certain stuff one way and we trade other stuff the other way, and it's perhaps not for everybody, but it's good that we talk about it because some people really do trade this way, and perhaps we can clarify a little bit how really long-term trades work and long-term money managers even work. Long-term money managers, they don't care about 50 or 100 points in the euro dollar, but they assuming that they want to buy, they will start to buy at 105 and buy until parity, and then see where we end up. But come 120, they will still be long, right? So that's a completely different kettle of fish. But it's worth mentioning here that those trades are just in the part of the market. Yeah, on gold. Yeah, this prior low 1804 again, and it's been a bit of a traffic zone before. I'm looking at 1780, 1788, 1790 to see if this move is going to go deeper, or we can really build a base there again. And the top side. Yeah, there's a bit going on, as I was saying, in the 1860s the other day, 50s, 60s, 42, 48, and then above there, that's going to be a big zone here again, anywhere between 1880 and 1900 in gold. But for the time being, not interested really. But I may get interested if Friday takes the dollar one way or the other. Yeah, so my zone in the US 10s. Tried to break above yesterday, logic on Powell, but can't hold it. And I think that those medium-term or longer-term expectations, I think we finished the week outside of these books, and that's where your dollar is going to go, especially in the combination of Bank of Japan, for instance, where the yen is really dragged around by this one. I think we should, at least on the labor report, unless we get a flattish labor report, we should break out of these books on Friday, and that's really when I'm going to really pay attention to this one, to see what's going to happen to the dollar come the end of this week. Yeah, the shorter end, I think I'm gonna have to attach post-its also to my charts here, right on the screen, because it's breaking. I should go back to much longer term, but since this market is so volatile, keep an eye on 5.5. We're turning around. 5.5 could be enough for this run. Until Friday. It's possible if it continues to push higher this afternoon on Powell, well, your dollar is probably going to continue to rally. See what happened on this euro dollar back up to 107, and then what happened yesterday on the short end differentials, massively back in the dollar favor, and that's your euro dollar back down to the 105s. And speaking about euro dollar, we are going to come up. We're coming up to my personal big zone, 104.60, 104.80. That's where really is going to play ball or not, this euro dollar. And for the time being, it's driven by the dollar. But I think, and I agree with Ryan there, that don't underestimate the euro side of any pair really on the crosses or versus dollar, because if the ECB continues to be hawkish, and if data don't fall out of bed, I know we had this inflation adjusted German number which came in crap, but if you look at the nominal number was positive. If also the industrial production was higher again. But then if you look at but those was Q4 GDP numbers, right? I mean, okay, moving on. I think there's still the potential for the euro to find a bottom somewhere, and that's going to be done more on the euro side. So I'm really closely monitoring this 104.6080 on the euro dollar. We need to get back above 106.20 in my opinion to get back to neutral and have a retest of 107. That's for the euro dollar. Cable. To me, we're on a bit of support here. I said it yesterday, 1540 cable. Keep an eye on it. And then that's just ahead of my personal strength weakness line in cable, which has always been for months now, really months. It's been 117.40-60 zone on the cable. And that is really going to tell me whether we are going to go drop all the way back down to likely 111s or starting to hold and then stabilize in this probably getting back above 120 and getting back into this range. For the time being, no real reason to, on the medium term anyway, to break above these. Already 121s have been proven difficult. So yeah, this is how the picture looks for the time being. And I'm voluntarily showing a little bit longer term because of what's coming up on Friday. And I'm cautiously watching a lot of pairs, dollar pairs right now. And a bit similar on the Aussie dollar. To me, the real zone. I took profit here yesterday around 66.10, and I said like, well, okay, it's a pretty decent level where we already had a bit of activity. I'm really looking at selling rallies again. If we get a really decent rally on the Aussie, I think RBA did more bad than good for the Aussie. For the time being, I think Aussie is a rally sell, but we're coming into interesting zones here. 65.25, 65.5. I think that zone needs to be respected. And we are seeing that on a lot of dollar pairs, right? The euro dollar, the cable, I've been showing now the Aussie dollar. It's similar. Kiwi gave up the 62, but then again, 60, well, it's a bit wider zone. 60.25 is the 50% of the October-February rally. In just above there, we have the 60-65. And that's, again, another one of those dollar zones where in the next 0.5 to 1%, we could see some really interesting levels coming up. Not going to talk about Noki. That thing is really so weak. But the one that I really want to show, and Ryan already touched upon it, is this mix. It's broken through levels, and the main level is broken through. I've been already speaking about that. Was these 1850s, and then but we are successively breaking other levels. This is back from 2017 high, the 2021 low before we bounced, and now we are below. Okay, only 2 touches, so that one is a little bit fragile. This one is shorter term and is coming up soon as well, around 1790, which is probably going to be the confirmation for the dollar mix to break down again, or just continue what it does right now. But if you look at the shorter term, I mean, this thing, if we thought, and if we look at moves like we had on the Rand, but you know my opinion on the Rand, and on other dollars, why couldn't it just even go above 1820 and get a move back to 1840, 1850? I mean, why not? Because the interest rates were differentials were getting reduced. I think the MEX is just an investment instrument now for many different investors as well. It is and I've been showing articles in the room as well. It is an investor's country, and right now, despite what Labrador may be doing right or wrong, and to me, this bounce is looking so anemic. It's really, I think. I was actually hoping for it to go higher, but it can't even take the first hurdle. And then on the Euromex, we really tried to get back higher from the 1908 that we saw. We tried, but then if you look at what's a bit of a bear flag here, we didn't even go and test it. And I was hoping for it to go and retest higher levels, but it's just not happening. And we have to, if it's not happening, there's most of the time only one way. And again, the market can turn on a dime, and that's why we are risk takers. With everything we do, there's a risk. But if you look at how this is behaving, it's weak. It's extremely weak still. And so I reckon sooner or later we are going to be trading lows here. And you can, I'm looking at Euromex because you can look at a lot of instruments, and I don't want to get involved in MEX yen before the Bank of Japan, but just overlay all MEX crosses. They all look exactly the same. And I'm
guys, I have to run. I'll let you finish up, okay?
No, I'm gonna stop there, Ryan. Back to you.
No.
Yep. Thank you very much, Still. Speak to you later, mate.
Thanks.
Yeah,
thanks, guys.
Kate. Thank you very much. Yeah, you know, we want to know what happens next with prices. If you weren't in moves yesterday, you want to get in them. Some of you want to fight them. The only advice I can give is pick your levels. If you want to go with something, get in a trade, get in a trend, fight a trend, pick your battlegrounds. Make sure you're getting in or trying to trade the places where your risk can be as minimal as possible. If you want to fight against a trend, keep your stops tight, because if it keeps on moving, you don't want to be pissing against that strong wind. So keep your risk lower, keep your stops tight. If you want to get in with a trend, look for the retraces, and where they hold, like Kay's just shown there, even the minor levels can bring you the rewards. So that's it for today. We go all again. We've got ADP today, Bank of Canada today, so we'll have plenty more to talk about tomorrow. Trade safe, trade well, make loads of pips, and we'll find out what all happens tomorrow. Cheers, Kay. Thank you, people.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.